10 to 15 lakhs, that's the cost of single bypass surgery in metro today. And if you think jab hoga tab dekhenge, you are gambling with your entire life saving. Today we will demystify health insurance, how it works, which plans really matters, and the tricks insurance companies use to confuse you. By the end, you will know exactly how to protect your family and your money. Here's something that will grab your attention. The global health insurance market is expected to nearly double from $2.3 trillion in 2025 to $4.45 trillion by 2032. That's a massive growth, and it's happening because medical costs everywhere are rising fast. Now, let's bring this into perspective. In India, one hospitalization already costs 35,000 in rural areas and over a lakh in cities. A bypass surgery, at least 10 lakhs. Severe illness like cancer or kidney failure, 15 to 20 lakhs can disappear from your bank account in just weeks. Picture this: your child's education fund gone, your retirement savings wiped out. Millions of Indian families face this reality, and most of them had insurance but didn't choose the right plan. Here's the terrifying reality. Your salary may grow at 6 to 7% per year, but medical costs in India are rising at 14% annually. That means a 5 lakh procedure today becomes 10 lakhs in just 5 years. Globally, US spends about 17.2% of its GDP on healthcare, while Singapore achieves better outcomes at 4.9%. India is catching up very fast. Without insurance, you're paying these skyrocketing costs out of pocket, and that's exactly why planning early is extremely essential. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firms before launching my own startup. This is Finicky, where I simplify money the same way I practice it, with clear, actionable advice that anyone can follow. Why health insurance matters. Young people often say, I'm healthy, I don't need it, my company covers me. But illness doesn't check your date of birth certificate. Even a 25-year-old can have an accident, a sudden diagnosis, or a condition that requires surgery. And corporate health insurance cover? It actually disappears the day you leave your job. Health insurance is not just about paying premiums, it's your shield, it's your safety net, and your family's financial security in one package. Let's take this example of a friend of mine. Let's call him Raj. He was 32, fit, regularly exercised, and one night a car accident left him hospitalized with fractured leg and internal bleeding. His corporate insurance covered only 3 lakhs and his medical bills ran up to 7 lakhs. Because he had a personal policy alongside, that remaining 4 lakhs was covered by that policy. Without it, Raj would have actually had to borrow or liquidate investment just to survive the emergency. So, how health insurance actually works? Most people think health insurance is simple, pay 15 to 20,000 a year, hopefully you'll never need it again. Absolutely wrong. Here's how it actually works in reality. Choose a sum insured. For example, 5 lakhs, that's the maximum insurer will pay in case of an emergency in a year. 2. Network hospital. Cashless treatment, you don't touch a rupee, the insurance will pay directly to the hospitals. 3. Non-network hospital. Pay first, then submit the documents for reimbursement. Think of health insurance like a fire extinguisher. You hope you never need it, but when a fire happens, it saves your house. Health insurance is your financial fire extinguisher. Look at this example of a 28-year-old who needs an appendix surgery, which is cost about 5 lakhs. With insurance, the insurer pays directly. The patient walks out debt-free. This is risk sharing, a pool of premium from all members protect the few facing emergencies. Now, let's break down the jargons so you are not confused with these terms when it comes to insurance. Waiting period. Some conditions only covered after 2 years. This is for heart conditions, diabetes, etc. Pre-existing disease cover. Coverage may start only after 2 to 4 years after purchase. Don't hide these conditions, it can lead to claim rejections in the future. Room rent limit. Policy allows 5,000 per day and you choose a 10,000 room, you pay for the proportionate increase in the hospital bills from your pocket. Copay. You actually share cost with the insurer. If you choose a 20% copay, on a 5 lakh bill, you pay 1 lakh. Deductible. You pay first, insurer covers the rest. It's very common in top-up plans. For example, a 1 lakh deductible would mean Up to 1 lakh you have to cover, and expenses over and above 1 lakh will be covered by the insurance. These are measures used to typically reduce insurance premiums. Sublimits, caps for specific treatments. You'll see for most insurance, maternity might be capped at 50,000 or so. That is called as sublimit. No claim bonus. Stay healthy, your 10 lakh cover can grow to 50 lakhs without extra premiums. It's like compounding interest for your insurance. Why am I saying all of these things? Because if you understand these terms, you'll never be surprised by a claim rejection, and in fact, you can maximize on your policy. So what are the types of plan? Individual plans. Covers one person, simple but costly for families. Family floaters. Shared covered for spouse, kids and parents. Cheaper but risky if multiple members need care. Critical illness cover. Lump sum payout on diagnosis, no hospitalization required, used for treatment, income replacement or even rehabilitation. Top-ups and super top-ups, extra coverage for large bills. Typically, super top-up is superior, considers total year expenses and not per incident. Employer cover, good perk, never relies solely, treat as extra layer. Many countries including Singapore combines family floaters with mandatory health savings accounts. This keeps premium affordable while ensuring everyone is covered. A model India should learn from too. So how to choose cover and actually how much? Never chase cheap premiums. Check claim settlement ratio, that is how often the insurance company pays for claims. Network hospitals in your city, sublimits, co-pays, exclusions, etc. So what should you consider for coverage guidelines? At least a minimum of higher of 50% of annual income or 10 lakhs. For metro cities, aim 10 to 20 lakhs minimum. Dependents are there, then add at least 5 to 10 lakhs per dependents. Liabilities and family histories, push to 20 to 30 lakhs at least. Combine family floater, super topper plus critical illness for maximum protection at an affordable cost. Review every 2 to 3 years because medical inflation outpaces salaries. So, what are the common mistakes? 1. Relying only on employer cover. This coverage ends with job change, too low coverage many a times and dependent on your designation in the organization. 2. Delaying purchase. The result, premiums increase with age. I've seen many opt for insurance post-retirement as the company policy is no longer valid for them and ending up with extremely high premiums. And the worst case is that by the time you actually decide to buy, you may already have pre-existing conditions that won't be covered for the first few years, leaving you vulnerable. 3. Buying for tax benefit. A lot of people also make the mistake of buying insurance only for tax savings under Section 80D. While tax benefits are a nice bonus, they should never be the main reason to buy a policy. The purpose of health insurance is protection, not saving tax. 4. Ignoring fine print. Details like room rent limits, disease-specific caps, or mandatory copay can drastically reduce your claim amount. Always read and understand these clauses before finalizing a policy, as this can be costly if ignored at the time of policy purchase. See this example. Priya bought a cheap corporate-only plan. When she got diagnosed with gallstone, her claim got rejected due to a sublimit clause. Lesson: always read the fine print. While I'm talking about all of these things, there's a lot of changes that is happening at the insurance industry level. The industry is actually changing very fast. AI claims processing, simple claims approved in hours, telemedicine, virtual consultation now integrated in almost all policies. These are added benefits. Wearables and data-driven premiums are now a trend. Health monitoring can reduce premiums. This is being implemented especially in the West. Wellness programs, incentives for preemptive care, screenings and chronic disease management, again a measure to reduce claims for insurance companies. Having said all of these, let me leave you with this. One major hospital bill can wipe out years of savings in just few days. That's why health insurance is not an expense, it's a shield. Start early in your 20s or 30s when premiums are very low and coverages are wide. Be smart, combine a solid base plan with a super top-up to get big protection without burning your pocket. Review your policy every few years as your needs change and always declare existing conditions honestly, because hiding them could mean rejection when you need help the most. At the end of the day, a single good policy can protect your family, your wealth, and your peace of mind. So please don't wait for the moment when you say जब होगा तब देख लेंगे, because by then it might already be too late. The best time to act is today. If you still have any doubts with your health insurance, comment below and I'll address each one personally. Share this video with someone who needs to hear this hard truth and change their approach to health insurance. That's it from me. I'm Nikhil Vargas. Share this video and subscribe to learn how to make your finances less tricky with Finicky.